2006, Miami. A man working in finance walks into a VIP club and starts chatting with a dancer. Her phone rings. When she hangs up, she casually mentions her home loan just got approved, a penthouse on the beach. As they talk, she reveals she already owns 5 other houses, plus a condo. The man is stunned. How does she afford the mortgages? She tells him she doesn't actually need to pay them off. The banks didn't even ask what she does for a living or how much she earns. They just gave her the money. Her strategy is to hold the properties for 6 months, wait for the price to double, and sell them at a massive profit. She was the beneficiary of a ninja loan. That stands for no income, no job, no assets. Lenders were aggressively seeking out anyone with a pulse to sign mortgage papers, completely removing traditional requirements like down payments, income verification, or credit checks. But this creates an obvious mathematical problem. Why would the most sophisticated financial institutions on the planet willingly hand over billions of dollars to borrowers they knew couldn't actually afford the monthly payments? The answer is that the local banks originating these risky subprime loans never intended to keep them. As soon as the ink dried on the mortgage, they used a process called securitization to instantly sell the debt up the chain to Wall Street investment firms. These Wall Street firms took thousands of these highly toxic individual home loans from people with bad credit, variable incomes, or no assets, and tossed them all into a giant blender. Out of that blender came a single financial product, the mortgage-backed security, or MBS. The idea was that by bundling thousands of bad loans together, the sheer volume somehow diluted the risk. But to sell this product, the banks needed a stamp of approval from the credit rating agencies. The agencies are supposed to be impartial umpires evaluating risk. But in the mid-2000s, the banks paid their fees. So to keep the banks happy, the rating agencies stamped these highly toxic bundles with their top AAA rating, declaring them perfectly safe. Armed with that fake AAA rating, Wall Street sold these mortgage-backed securities to the world, to pension funds, to retirement accounts, and foreign governments. They bought them up by the billions, fully believing they were purchasing investments as rock solid as a U.S. Treasury bond. The foundation of the global economy had decoupled from actual value. Trillions of dollars were circulating globally, based entirely on a systemic, highly profitable lie, rubber-stamped by the exact organizations tasked with protecting investors. When demand for these securities started to slip, Wall Street found a way to package the absolute worst unsold leftovers. They combined the lowest-rated, garbage sections of the mortgage bundles into new products called collateralized debt obligations, or CDOs. And once again, the rating agencies labeled them AAA. Deep down, the banks knew these loans were incredibly risky. To protect themselves, they started buying unregulated insurance policies, known as credit default swaps. You paid a premium, and if the mortgages in your bundles somehow failed, the insurance provider would pay you out. The primary provider writing these policies was the insurance giant AIG. They collected billions of dollars in premium payments, assuming a nationwide collapse in home prices was a statistical impossibility. Because they never expected to pay out, they didn't keep cash in reserve to cover their bets. The entire global financial matrix was now functioning as a massive, heavily leveraged Jenga tower. Trillions of dollars in complex bets and insurance contracts rested entirely on a single assumption: that low-income, subprime borrowers would keep paying their monthly mortgage bills. In 2007, the math caught up. The initial introductory periods on those mortgages expired, and adjustable interest rates skyrocketed. Borrowers found their monthly payments jumping hundreds or thousands of dollars overnight. They couldn't pay, they defaulted, and a glut of empty houses hit the market, driving property values straight down. The moment the underlying ninja loans stopped paying, the dominoes fell. Those AAA-rated mortgage-backed securities and CDOs instantly became worthless. The major banks suddenly found themselves holding trillions of dollars in assets that nobody wanted to buy. The climax arrived on September 15, 2008. Lehman Brothers, a Wall Street fixture for 158 years, was carrying so much of this toxic debt that it filed for bankruptcy. In a single day, $600 billion was wiped out of the financial system. Seeing Lehman executives carrying their belongings out of the building shattered the illusion of safety. Panic set in. Banks realized that no institution could be trusted to pay their debts, and global credit markets froze completely. The panic quickly escaped Wall Street. The Dow Jones dropped 778 points in a single day, bleeding the infection directly into the broader economy. The collateral damage on Main Street was catastrophic. Over 8 million Americans lost their jobs. Nearly 4 million homes fell into foreclosure. Entire retirement accounts evaporated in real time, wiping out decades of savings for working families. To stop total economic failure, the U.S. government stepped in. They passed the Troubled Asset Relief Program, using $700 billion of taxpayer money to rescue the exact same financial institutions that engineered the crash in the first place. The justification was a doctrine known as too big to fail. The Federal Reserve and the Treasury determined that these banks had intertwined themselves so deeply into global commerce that allowing them to die would trigger the collapse of the modern global economy. Only one high-ranking Wall Street executive went to jail. The institutions that created the toxic chain were rescued by the state, and the executives who profited kept their bonuses. The total cost of the collapse was handed directly to the ordinary citizens who had trusted the system to work.